What is up, guys? Welcome back to the channel Trading Simplified. Today we're going to break down another growth fund that I think you're going to enjoy. Let's get right into it. On Fidelity, Wisdomtree US Quality Growth Fund, ticker symbol QGRO. This is an investment that seeks to track the price of the US Quality Growth Index. What this means is it looks for market capitalization that is comprised of 100 US companies that are large and mid cap. So that's the only focus of this. It also says that it holds 25% or more of its total assets within a particular industry. What that means is that when we go over the composition, you're going to notice that 50% is weighted in technology stocks, which is wild. So let's do a quick overview of this and then we'll get into the details. This is the chart over here on the right side. You can see the expense ratio is 0.28%. And I know you think that's steep, but take a look at the growth of this, the max chart. This started at $25. It has nearly doubled, and it has only been 1 year. This is a new fund, started in 2023. Now remember, 2022, we had a bear market for that year. So we had a nice downturn, and it's doubled ever since. So we're going to go right into the composition of this because I want to get into the meat and potatoes of this. Looking at this, you are only getting 100 companies, large and mid cap only. And this is your top 10 holdings right here, 58.77%. And I like this fund because it is so focused on Microsoft, 10.76%, Apple, 9.4%, Nvidia, 9.28%, Google, 6.58%, Amazon, 5.66%, Meta, 5.65%. Broadcom, Tesla, Visa, and MasterCard. If I could pick 10 companies that I want to buy and hold forever, this is it right here. So this is excellent. But let's go into the view holdings by weight just to get a further look at it. And as you can see here, besides the top 10 that we highlighted right here, look below. You have AMD at 1.57%, Netflix, Adobe, Qualcomm. These are all well-established mid and large cap companies. Let's scroll to the bottom so we can see who made the cut at the lowest percentage. We have Roku, Liberty Broadband, Insight, Lamb Weston Holdings. I'm not sure what some of these are, but basically the first 50 I can recognize. Let's go back to the composition. North America, 100%, Giant, 58%, Large, 22%, and Median, 18.5%. This is in large growth companies. We have that mix of mid as well. But here's your sector allocation right here. 49.54%. I rounded up to 50% for technology. Consumer, 15.45%. Communications, 14%. Financials, 8%. And the rest is very small with healthcare at 5%. And the rest at 2 or less percentage. As you can see here, it is very semiconductor and software heavy. 19 and 18%. You know, you got those 100 companies, you're going to be focused on specific sections here, technology. What I like about it, it's passively managed large growth. When you look at the distribution expenses, you can see here, distribution yield 0.1%. That's kind of, you know, we're looking for growth, but we're not even getting really any yield on this. That's your dividend for newer investors. So you're going strictly for growth. Let's wait until we get to the performance and risk on this with that gross expense ratio at 0.28%. And look at that dividend it paid, 0.0, so 4 cents, 4 cents per share. That's not much. You're not in this for the dividends, just keep that in mind. Ratings and analysis, only been out for 1 year, so there's not going to be much. Short-term sentiment strong, weak in the midterm, long-term neutral. Let's look at the performance. It's going to be monstrous, because it started in 2022 during the crash, pretty much. The pullback of like 25% on the S&P. $10,000 investment up to $17,000, which is excellent. So here's your 1 year returns because it's such a new fund. And I can see that being a con about this fund is that it's only been out for 1 year. It's up 37% in 1 year. You're paying expense ratio of 0.28%. If you're making 37%, you're not going to care about 0.28. Let's just keep that in mind right there. Next, we're going to compare it to other ones. There is nothing available to compare to QGRW. It is in its own realm because it is so focused on tech and almost having 60%. But just so you guys know, this is an ETF. and it is sponsored by Wisdomtree Asset Management. And there are 5 managers within it. But comparing it to the US equity mean, you can see 0.28% expense ratio versus 0.39%. So it is very competitive. But here's, the net assets, 355 million, not bad for only being around for 1 year. And the annual turnover is only 1% compared to the US equity mean at 37%. Giving you another quick snapshot here. We know it's 100 companies, but just reminding you, if you're buying this, you're pretty much buying 58.77% within Microsoft, Apple, Nvidia, Google, Amazon, Meta, Broadcom, Tesla, Visa, and MasterCard. So keep that in mind. You don't really need to own these individual stocks in your other portfolios if you own this fund, unless you want to beef up Tesla. You can buy individual shares because it's only at 2.94%, and vice versa for Visa and MasterCard. Because when you got, let's say you had $10,000 invested, 1,000 of that's going to be within Microsoft at 10%. Just keep that in mind. And looking at the report here, just like we reviewed, just 100 of those large and mid-cap companies with the highest composite scores based on 2 fundamental factors, growth and quality. That's all they're looking for, growth and quality. And they are okay with being non-diversified, and this is 50% tech. And there's just reviewing your top 3 holdings again, Microsoft, Apple, Nvidia. Just look at that huge percentage, 30% just within 3 of those companies, highlighting them here for you as well to see. So definitely concentration risk at its finest right here. I want to break down the chart just in a little more detail. Let's go in the 2-year because we know it only goes to 2023. As you can see, we are trading in this trend channel, which is very nice. If you bought right from the get-go, all you did was make money. You can see here, this is your trend channel, and that's all it's done. So this company, this ETF, knows how to make money. 100 of them, and 59% allocated to just 10. So it's really up to you. Do you want to own these companies individually and just buy them separate and avoid the 0.28% fee? Or do you want to just get a basket of them, own these top 10 big dogs, and have them make up 59% of your portfolio? Leave that, that's a question for you to figure out if you want to invest in something like this. And just realize that if you were going to be buying the S&P 500 with this, you're going to be heavy tech weighted in the S&P 500 as well, like 29-30%. This fund is going to make up 50%. So it makes you try to rebalance the portfolio so you're not too one-sided in technology companies if you're buying other funds. All right, guys, this is my channel. I just posted this video on CTNT, made some money on that. Definitely be sure to check that out. Almost at 2,000 subscribers, so I appreciate you guys for subscribing and leaving comments in the section below. Always awesome. Love reading them. And definitely check out my content. I have plenty of stuff for you. Check out my playlist. Right under the playlist, I have the Trading P&L 2024, the Fidelity Index Funds and ETFs, where I'll be posting this one as well. Investing for beginners, investing ideas, penny stocks, long-term investments, Fidelity Active Trader Pro, Vanguard investments. I got to put a few more in here because there's definitely some good funds that Vanguard offers. And then the taxable portfolio, always revealed, showing you guys what I'm doing with my funds in my taxable account.